You can sleep easy at night knowing that your portfolio is not going to be wiped out. We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers. Welcome, everybody, to Talking Trades. You have my friend Kevin Wadsworth and myself, Patrick Karim. And today, Kevin's going to talk to you about a very, very important subject that's not talked about enough in the financial world, in the trading world, and that's risk and money management. And he's going to give you some good details, insight on how to properly assess that with a chart. Super easy to do. So without no further ado, Kevin, show everybody how we apply risk and money management to chart trade setup.
Yeah, thanks, Pat. Well, the show's called Talking Trades, isn't it? So I thought for this episode, I would talk about trades very specifically and how you can limit the amount of potential damage that you might see to your portfolio if things don't work out the way you expect them to. So it's probably going to make a lot more sense if I share my screen and show you exactly what I'm talking about. So what we've got here is the chart for Bitcoin. And of course, Kinesis gives you access to gold, silver, and cryptocurrencies, Bitcoin included, of course. So let's just assume for a moment that we are in the market to buy some more Bitcoin. Okay. Now, the first thing we'd want to do is look at the technical chart and identify whether or not we want to be buying it in the first place. And very quickly and easily with technical analysis, you can identify support and resistance levels. And it's very clear with Bitcoin, of course, that we've got a very important resistance zone just immediately above where the price of Bitcoin is at the moment. And this entire correction that's been going on for most of this year is contained below a support line. I've marked it in red for you. So we've identified the point at which we would start to get interested in Bitcoin. And if I just illustrate a potential scenario for you, let's say Bitcoin pulls back to somewhere around about 53,000 US dollars and then bounces up and breaks out and goes all the way up to somewhere a lot higher, let's say. What we're assuming here is that the support level or the support line holds, and we're assuming that price is going to break out at some point in the future. So let's not make any assumptions. Let's wait until price does actually break out. Wait until a technical chart tells us that price is breaking out, because for all we know, the price could come all the way down here, the support line could fail, and Bitcoin could end up tumbling. And all the while, other assets, perhaps gold or silver or something else, is massively outperforming Bitcoin. So, we wouldn't want to be in that trade. So let's wait for the evidence. Let's wait for the technical chart to tell us with a high degree of certainty that Bitcoin is entering a new bullish phase. And we've got a very clear level here that tells us when that would happen. So how do we make sure that we manage our risk here? This is how a professional trader would do it. So using a measuring tool that's available on most technical chart platforms, we can highlight the point at which we would enter the trade. And let's assume that we don't enter it until somewhere a little bit above 73,000, for example, 73,000 US dollars. And let's assume that we've measured a target that takes us up to 150,000 US dollars. And you can do that in a number of ways, number of technical techniques for measuring where the target might be. And there's one of them there. It's a simple flagpole measured move. There's your flagpole down there. The red thing there is the flag, and measured move on top of that. So that's just one very quick, easy, simple way of estimating a potential, not a definite, but a potential target. And we're setting our target actually a little bit below that measured move. So we're being very cautious. Okay, it's always a good thing to not sort of assume that it's going to go right the way to the top of your target area. Just be a little bit more realistic, a little bit cautious. So let's say we set it at 150,000. So there you go. You've got your entry point at just over 73,000. You've got your exit point at somewhere around about 150,000. The final thing you need to decide here is, where is your stop loss? Where do you put that stop loss? Now, you could put it just below that resistance zone, okay? And you could work on the basis that the price falling back below that resistance zone after a breakout is sufficient for you to decide to exit the trade. If you were to do that, you'd have a reward to risk ratio of more than 6 to 1. The only danger of that is that if price does come back down here, it could temporarily break back below that level, bounce off the support line, and then end up going up to your 150,000 target, and you would have been stopped out of the trade. So if you want to be sure that you're not going to be stopped out of the trade in that scenario, you would set your stop loss just below this swing low here. You see these two candles, the red candle and the green candle, in September of this year, just a few weeks ago. So you would set your stop loss just below that, and that's giving you a very nice, almost 4-to-1 reward to risk. That means that for every $1,000 you risk, if the trade doesn't work out, you are getting a potential gain of very nearly $4,000. You can see the numbers there. $99,000 is what you'd be left with if the trade doesn't work out, and nearly $104,000 is what you would have if the trade does work out. So by using risk and money management like this, and making sure that your risk to reward ratio is at least 3 or 4 to 1 each time, it means that you can have at least 2 losers for every 1 winner, and you're still making a profit. Because if you have 2 losers, you're going to lose $2,000, and if you have 1 winner, you're going to win nearly $4,000. So as long as you're getting a winner for every 2 losers, or even 1 out of 4 would stop you making losses. If you had 3 losers losing you 3,000, and then 1 winner, you get you more than 3,000 back. So you're still making a slight profit, even if you have only 1 winner out of every 4. And that's what we call risk and money management, Pat. That is how professional traders over time make sure that by combining technical chart analysis, support and resistance levels, and this very clever mathematical way of analyzing the risk and money management, it allows you to have more losers than winners, and yet still be coming out in profit. And using these tools, you can fiddle around with your risk percentage as well. I've got it set at 1% here. So if you have a 100,000 NAV, net asset value, and you're risking 1%, that means you're going to lose $1,000. That's 1% of 100,000. So if the trade doesn't work out, you lose $1,000. And that's how risk and money management works, Pat. You decide on how much you are prepared to risk. You set your profit limit, your target. You set your entry point. You set your stop loss. And then you go and put your feet up, take a break, go away on holiday, do whatever you want to do. And you can sleep easy at night knowing that your portfolio is not going to be wiped out. There you go, Pat. That's me talking trades for today.
Thanks, Kev. And just to mention, guys, when you say risk, that's not the position size. He's not buying $1,000 worth of that Bitcoin. That's how much he's going to lose if that price from the entry point goes all the way down. He'll be buying much more than that. It's just that once he loses $1,000 off that position value, that's it. We're out until the next trade.
Absolutely.
All right, guys. Thanks for watching. Hopefully this gives you some insight into how professional traders set up their trades. And that was Kevin and I. Don't forget to subscribe, Talking Trades. Come check us out. Take care.